Can you weigh in on the world of crypto? Because we've had that conversation a lot over the years, and I know you've been somewhat skeptical, I think, of maybe crypto as a currency, but you've been bullish in terms of on the blockchain. Clearly, the valuations of a lot of the exchanges, even the folks that are trying to do this on an institutional basis, there's been a lot of conversation about sort of where Goldman fits into the crypto landscape in the future. Do you think that this changes the dynamic in terms of the price coming down, of how even a Goldman Sachs or some of your competitors may think about crypto?
I continue to be a real bull on the digital disruption of the financial infrastructure that underpins everything that we and others that interact in the financial system, do on a day-to-day basis. The way money moves around the world, the way we can keep track of things, the way we can create automation and efficiency. Big believer that blockchain and other technologies, some that exist, some that haven't been developed yet, give us great latitude to really evolve that infrastructure, create less friction for end users, more efficiency, cheaper products and services. And so I'm a big believer in that. And we've been investing a lot in that. With respect to cryptocurrencies, as you appropriately point out, the regulatory construct does not let us do a lot. We talk to clients. We try to respond to inquiries from clients. We're trying to find interesting ways to use the blockchain and use technology in the world that we operate in. So, we've been involved in the construct of doing some repo on the blockchain. We've been involved in making loans that are secured, structurally secured by somebody who would custody some sort of cryptocurrency. But at the end of the day, I don't have a strong view. Bitcoin up, down, sideways.
But I think
here.
a lot of people,
I'm more focused on
the
technology infrastructure than I am on cryptocurrencies.
But when you look, we've been watching this Target news. We saw the Walmart news yesterday. You're spending a lot of time talking to CEOs, especially as this market has contracted. Where are we?
Well, we're on a journey in progress of tightening economic conditions. And, one of the things I just observed, up to this point, there's no question the Fed's taking action. The Fed is working to tighten monetary conditions. Monetary conditions are getting tighter. Fiscal conditions are certainly getting tighter. And that's having an impact on asset prices. Stocks are assets, and it's having an impact on those prices. I would say there's nothing that surprising about what's happened so far. Obviously, I can't predict, no one can predict how we kind of go through this journey and how we land the plane or settle out. Can we have a soft landing per se? But I would say so far, with a tightening, with real tightening of monetary conditions, this has been relatively predictable and, not that volatile relative to
But if so
other
predictable,
environments.
why do you think that the market has missed it in some ways?
Well, I don't have a good sense of any individual place or any individual stock, but generally speaking, when you tighten economic conditions, you have an impact on asset prices. So we had very, very easy monetary policy for a long time, and that definitely inflated asset values. And now that we're tightening monetary conditions, it shouldn't be surprising that in places where valuations were most forward, where people were really focused on the forward and what could be and what might be, that's the first place where you actually see valuations and asset values contract.
So when clients call you and say, okay, so what's the next 18 months look like from your perspective, the house view, the David Solomon view, what does it look like? Are we in a recession?
Well, the house view is slowing economic activity, higher rates, and probably a 30% chance of recession as you look forward over the next 12 to 24 months. What I would say, and that's our research, our research point of view, what I would say when I'm advising clients is we're going to tighten economic conditions. It's going to have an impact on a number of things in your business that are hard to predict. You have to be thinking about your risk appetite. You have to be thinking about your planning. You have to think about the fact that we probably at some point, that there's a reasonable chance at some point that we have a recession or we have, very, very slow, sluggish growth. And so start preparing for that. Start thinking about that. That doesn't mean that that's definitely going to happen. But certainly, I think that if you're running a significant enterprise, you have to be looking through a lens with a little bit more caution right now than you might have been when we were sitting here a year ago.
How many calls are you getting about M&A in this moment? Companies that all of a sudden were completely off the table that might now be on the table?
Well, I think that consumer confidence and CEO confidence always has an impact on M&A. And so there's no question, with confidence waning a little bit, that you're not seeing the same velocity of activity that we saw maybe 12 to 18 months ago. However, I will say, because the economic landscape is changing significantly, people are thinking a lot about how to best position themselves competitively. And there are a number of companies that thought that they were going to have easy access to capital that now probably have a harder journey to raise the capital they need to execute on their plans. So I would say the dialogue level inside our organization with companies large and small is very, very robust. You're also seeing a significant increase in activism.
Right.
Because of a reset in values, we're seeing more dialogues around take privates. And so the activity levels are still high. Now, whether that all comes to fruition and the pace at which that comes to fruition, you have to wait and see.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And we have David Solomon for Goldman Sachs. He's definitely a bull on the fourth industrial revolution. He knows what cryptos is about. The robots, algorithms, and drones that take over the economy. And he stated you should not be surprised that the market is tanking. Is he correct? Yes, he is. That's the reason why I gave you the warning. The Fed is going to bring down America to Babylon. This is biblical, people. If you have my book, you understand. And we have Janet Yellen. The dollar is as strong as it's ever been. We know Janet Yellen and Gary Gensler are the chess pieces for the NWO. Everybody's rushing into the dollar for a safe haven. And the Fed has something for them, because they're going to bring the house down. Yes, this is synchronized. They have to bring the global economy to its knees in order for China, the dragon, to rise. We just heard Yellen just say that the tariffs on China was not warranted by Trump. And guys, we know this is nothing but the Hegelian dialectic. Now, she says Europe needs to wing itself off of Russia. But she doesn't say America needs to wing itself off of China. Don't fall for the Hegelian dialectic. What do we see Janet Yellen wearing? That's right, the purple and pearls. She rides the beast. This is biblical. And remember, the Crypto Teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
About tariffs are underway in the administration. I've said previously that I think that some of the tariffs that were imposed by President Trump in retaliation for China's unfair trade practices, some of them, to me, seem as though they impose more harm on consumers and businesses and aren't very strategic in the sense of addressing real issues we have with China, whether it concerns supply chain vulnerabilities, national security issues, or other unfair trade practices. And so I see a case not only because of inflation, but because there would be benefits to consumers and firms from some of the tariffs, that some relief could come from cutting some of them. But we're having these discussions. There are a variety of impacts. There are a variety of opinions, and we really haven't sorted out yet, come to agreement on where to be on tariffs. And I respect the opinions I hear expressed around the policy table. There are a variety of valid concerns.
The United States, Europe, and China might end up in some kind of synchronized recession, like Ken Rogoff and other economists have predicted. Thank you.
I mean, I really hope that doesn't happen. We're committed to a market-determined exchange rate, although we've made clear that actions that countries specifically take to push down the value of their currencies in order to distort trade in their favor, that we will respond to that. But we have a market-determined exchange rate and think that's the best regime. I think you pointed to one factor, tighter monetary policy in the United States, rising interest rates, that is causing capital to flow toward the United States and into dollars. Also, at a time of kind of risk off and uncertainty, it's natural the dollar is a global safe haven, and we tend to experience inflows naturally that push up the dollar in highly uncertain economic times. So I think it's understandable that the dollar has risen. But you pointed to impacts on other countries, and that is a concern. There are many countries with dollar-denominated debt, and a rising dollar makes it more difficult for countries to bear that debt. We know that often emerging markets worry about how they will fare in an environment of higher interest rates and tightening monetary policy. I saw that myself when I was Fed chair and we began to tighten. And I think continuing to keep our neighbors well informed. The Fed, of course, runs an independent monetary policy, but attempting to be clear about what our policy is, I think, is an important strategy for helping our neighbors adjust. Begins to ramp up. We expect to see a significant supply response in the United States and other parts of the world. In the meantime, the releases from the Strategic Petroleum Reserve, I think, are serving to basically stabilize prices. And so we're doing what we can to avoid further increases in energy prices. But, we also want to make sure that we wean, Europe especially, weans itself from dependence on reliance on Russia for oil and gas. And these pressures are, not likely to abate in the very near. With respect to China, certainly the lockdowns look like they are impeding the production and flow of goods and services, given how extensive they are, and compounding supply chain difficulties that we have had that have boosted prices, although some of those pressures seem to be mitigating. The developments in China exacerbate those supply chain pressures, and so that's a source of concern. China also seems to be experiencing a slowdown in growth, and as one of the largest economies in the globe, China's economic performance really has spillover impacts on growth all around the world, and so that is a factor that affects the global outlook, and we're monitoring carefully what happens in China and what their policy response.
We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort, and China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
Most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids' books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.